Okay, hello, my dear friends. Very good morning to all of you. Hope you are ready for day 2 of the revision series. And I also hope that you are able to solve the MCQ questions that you have given yesterday. Many of you requested that you need some more time to write these MCQ tests. So I'm keeping it open till end of this series. So June 8th or 9th I'm planning to close. So I will keep all these MCQ tests open till the June 10th. So if you don't do it today, it will get accumulated tomorrow, so and so on. So you will get very less time to write. So I see very few of you taking test. So I strictly recommend, please write those, and the result also I'll be uploading it to you. But before we go to the topic, let us do a quick revision of what you have done yesterday. This itself is a revision series, but a revision of that as well. And then we'll go for a quick discussion on the MCQ part, whichever area where you are finding it trouble, not all the questions, few questions, and then we go to the next set of problems. Okay, so okay, let's come to the questions that we have discussed so far. Many of you have asked me for this question, which is frequently missed question, I would say, related to this revaluation profit, I believe. Let me try to select that question. Okay, sorry, before that, let us just try to let me just first revise the thing what we discussed today, then I will go for that question. Okay, so this is the working note format what we discussed. Consolidation is a process of adding holding company and subsidiary company into one balance sheet called as consolidated financial statement. Holding company has investment in subsidiary company. That investment is taken out, and it is substituted by the assets and liabilities of the subsidiary. So in that process, we gone for the working note format, 3 columnar working note format, goodwill column, then CONPL or other equity, and then NCI. We start with the subsidiary company details. Subsidiary company share capital, one amount will write it, holding company share will go to goodwill column, and the outsider share will go to NCI column. Pre-acquisition profit, again same treatment. Post-acquisition profit, holding company share goes to CONPL, outsider shares goes to NCI. Other adjustments also we discussed, that is revaluation profit done at the time of acquisition is very similar to pre-acquisition profit. Then we discussed about whenever there is revaluation, there has to be an impact on depreciation, which is a post-acquisition element. So it will be taken in the CONPL column and NCI column. Then the unrealized profit by subsidiary, there is on goods sold by subsidiary, one portion is taken to CONPL column, one portion is taken to NCI column. Then NCI adjustment is done whenever the entity elects to value NCI on fair value basis. We compare the proportionate value of the net assets related to NCI, compare it with fair value. If the fair value is high, we will add in NCI column and we subtract in goodwill column, and vice versa. Many of you requested for a problem in this case. I will be solving it as well. In the chain holding, I'll solve it. Then dividend paid, proposed dividend declared should be ignored, and dividend proposed and dividend declared should be ignored. Dividend paid should be considered in these adjustments. It should be added to the current year P&L account and closing balance of P&L account. Then you do pre and post classification. And dividend paid, no worry about pre-post classification, subtract in CONPL and subtract in NCI. That is the simplest adjustment. Then you come to holding company heading, investment you subtract in goodwill column, P&L account reserves of holding company will come to CONPL, other equity column, and the unrealized profit on goods sold by the holding company is subtracted entirely in CONPL column. And the impairment of goodwill, written off, in such case it will be added in goodwill column, subtracted in CONPL column. But if it is a fair value method goodwill, then one portion should also be subtracted not only in CONPL but also in NCI. And debentures, preference shares, the difference between the face value and investment also should be taken to con PL. So this is the overall structure what we discussed. In one place all set of working note comes. Okay, now let us discuss some questions that some of you wanted to discuss about. Yeah. I'll just put that, give me 1 second. I think many of you wanted this particular question, right? Please confirm it related to this revaluation profit adjustment, right? Can you please confirm? Is this the question you are looking for? Many of you wanted to understand this. Okay. I would like to solve this question quickly. PP of subsidiary on 1/4/2018 was 10 lakh. Date of acquisition 1/1/2019. PP of subsidiary on 31st March 2019 is 8 lakh. PP is revalued at 9 lakh 10,000. Then on the date of acquisition, then. Okay, let me do it. So what the format we are going to do? We will be starting with opening balance, right? Then we do less depreciation. Then we get the WDV as on the date of acquisition, then less depreciation, then we get WDV at year end on the date of consolidation. This is the format. And the heading columnar what we are going to give is in the books of subsidiary, which is already provided, then in the books of group, and then we are going to compute incremental amounts. This is the format. Now, given opening balance is 10 lakh and WDV at the year end balance is given to be 8 lakh. Okay, therefore, if 10 lakh becomes 8 lakh, assuming no purchases and no sales, then you will have depreciation to be 2 lakh. And therefore, rate of depreciation, if you want to compute, that will be 2 lakh divided by 10 lakh, which means you get 20% per annum. Okay. Now 20% per annum. Therefore, if I compute the depreciation for what period? Date of acquisition means 1st of January. From 1st of April to 1st of January means 9 months. So 10 lakh into depreciation for the first period is 10 lakh into 20% into 9 by 12. That comes to 1,50,000. And therefore WDV comes to 8,50,000 and depreciation again 50,000. That's how 8 lakh is reached. And it is revalued at 9,10,000 in the group books. Since it is revalued higher by 60,000, that is your revaluation profit 60,000. 60,000 is revaluation profit. Okay, now then we will be having the depreciation on 9,10,000. How it is going to be there? 9,10,000 into 20% into the next period from the date of acquisition till the year end, which is 3 months, and that comes to I think 45,500. Yeah, 45,500. So this is what is important. Depreciation already charged to P&L account of subsidiary was 50,000, but based on the revalued amount you are supposed to charge only 45,500. So you have charged more, you're supposed to charge less. The difference 4,500 is to be reduced. To be reduced means that is the depreciation to be returned back. And mostly we always discussed, whenever there is a revaluation profit, depreciation will be an expense, and whenever there is a revaluation loss, we discuss the depreciation will be right back. But this case it is not. I'll tell you why it is not happening when this special situation arises. See, the revalued amount 9,10,000 is below original value. 9,10,000 is the revalued amount. Original book value is 10 lakh. That is, you are not revaluing more than opening balance. In such case, this special situation arises. I repeat, whenever the revalued amount is less than the opening book value, still there is a profit, still there is a revaluation profit. In such case, this special scenario of revaluation profit and depreciation write back will arise. This is an exceptional situation. I have not seen in any CA questions so far. Okay, I hope this point is clarified. My dear friends, do you want any other question to be discussed now? I think this was the only trickier part. All of you got the other, majority of you got the other ones. Let me know if you have any other specific areas that I need to address. Any other questions, my dear friends? Write back means 4,500 in post acquisition profit. Yes, it is post acquisition profits and positive number 4,500 positive numbers. Priya says investment associates, patience, have patience. I'll explain. I'm covering that. If you're not downloaded the question from the my Telegram channel, please join and download the notes. Questions are available there and you'll get an idea what questions are going to be solved. Revaluation profit to be classified as OCI? Yes, it is classified as OCI, but we are having one column only for examination purpose, but for reporting in practical, yes, it is OCI. Revaluation profit is OCI. Ruchi Jain is asking fourth question. Let me just go through what is fourth question. One, two, three, four. Date of acquisition, NCI share of pre-acquisition profits. Okay, I'll quickly tell you the NCI share of pre-acquisition profits. 2 lakh was the reserves, and then they made a profit of year end 2,20,000. So incremental profit is 20,000. Divide in number of months, that is up to date of acquisition will be for a period of 3 months. So 20,000 into 3 by 12 means 5,000. So 2 lakh plus 5,000. The pre-acquisition profit is 2,05,000, and 2,05,000 into NCI share 20%, you get 41,000. 2,05,000 into 20%. 2,05,000 into 20%. Okay, I think I got the, I've discussed major points. So if you still have any questions, please join the Telegram group in the description below. You can ask the questions there. I will address the queries. And I repeat, this MCQ will be open till June 10th. Only then I will be sending you, each one of you, mail with your respective scores in each assessment test. No cost, free of you. Some of the questions I'll read it out. Dividend paid is to be added back in the profit made during the year, but in MCQ it was not added. That was not done because dividend paid in the next year. The MCQ question is slightly tricky question. The dividend was P&L given for you 16-17, but dividend paid next year. So dividend is not added. So tricky question. Just read it once more. You'll focus on the dates and year ends. Dear sir, need the solution for November 2012 and Peace Limited. I will not be able to solve now. Maybe I will solve it and upload it in the Telegram group. You can download it there. That's the help I can do. Sir, is revalued amount below lakh? I've not got the question. Gokul Pai, sir, if it is revalued below lakh, okay. If it is revalued below WDV, obviously revaluation loss will come. Write back also will come. So I'm talking about the special situation. What is special situation? You are getting the revaluation profit as compared to WDV as on date of acquisition, but when you compare it to the beginning of the year, that one amount is less. So if you compare to WDV, this revalued amount is high, but when you compare it to opening balance, revaluation amount is low. So when the revaluation amount is in between the opening balance and the revalued amount, in between comes, that is a special situation, and that is when this case will arise. Okay, hope my dear friends you got all the things clarified. If you have any other questions, please get it clarified in the Telegram group, because here we have to move forward. And I repeat, this is only for new syllabus. Today's session, chain holding problem, multiple acquisition problem, is only related to new syllabus treatment. Old syllabus people will get confused. So I don't want you to confuse yourself by joining this. So only new syllabus people attend today. Tomorrow you can join for the old syllabus people also. Common will be there. Okay, good. What if proposed dividend is given the balance sheet instead in the adjustment? Proposed dividend, if you are preparing for the year 31st March 2019, proposed dividend is next subsequent year, ignore it, not required. Okay. Let us go further with respect to chain holding, because that requires more intention from our side. Okay. Now, take a look at this example, my dear friends. Please come back to chain holding. I just want to make sure that you are able to see this PPT and you are able to listen to my voice clearly. Can you please give me the confirmation? Because chain holding is important. Okay, good. I'm getting confirmations. Let us proceed. Good. This is important. So take a look at this example. Company A is having 70% in company B, and company B is having 60% in company C. And A also additionally has 5% directly in C. You may say chain holding problem, or you may say this is a triangular holding problem. Both are same. Both will have same treatment. There are two things to be looked at. One, for the purpose of assessment of control, whether there is control or not, one type of discussion should be happening. I will not touch that, because for following full-fledged problems, that is not required. Another point is the assessment of percentage for the purpose of solving problem, for the purpose of consolidation. So two elements, for the purpose of assessment of control and for the purpose of consolidation. For the purpose of assessment, I will not do it. That is different area. I will focus on for solving problem what needs to be understood. Okay. Now, if you see company C point of view, company C 100%. If I divide this into shareholders, there are three kinds of shareholders. One is company B, who is having 60% here, 60%. Other is company A, who is having 5%, and others, who is having 35% shareholding. This is the shareholding structure, shareholding pattern in subsidiary C Limited. Now B Limited, if you focus here, What is the ownership pattern of B Limited? 70% is owned by A. So if I divide this, A, 70% is owned by A, 70% is owned by A, and others 30%. So if I try to understand the ownership of 60%, if I divide it among its own shareholders, A will have 70% of what? 70% of 60%, that is 42%. And others 30% of 60% means it will be 18%. So if I want to talk about what is the ownership structure in C by A or by the group, it is 42% and 5%, that is 47% is shared by group, balance 18% and 35%, that is 53% is shared by others. So that will become NCI and this will become holding company share. This is the structure in which the shareholding need to be analyzed. Now, this is for understanding purpose. Now, while solving the problem, what you need to do, just do this. Holding company share. I'll give you shortcut, follow this. Holding company share is calculated as percentage of, or you can write it as A in B in C. Percentage you take. What is A in B? 70%. What is B in C? 60%. Multiply, you get 42%. A in B in C, that is indirect holding. Then what is A in C directly? A in C directly is 5%. Therefore, you get total 47%, that is holding company share. So NCI share is remaining, and that is 53%. That's all you have to do. So when you try to analyze the subsidiary company profits related to C, A in B in C, percentage of percentage, then A in C, percentage, add those two numbers and then you are done with the percentage calculations. So it's very simple. Now one more portion you need to be worried about, one more adjustment. Now B also having one investment in C, right? B is also having investment in C. An intermediary holding company has got investments. So when we write the heading goodwill one column, con PL one column, NCI another column, and we will be starting with C Limited, no issues. We will be writing B Limited. In that we will write investment, right? Focus here, my dear friends. B Limited investments, the subsidiary, that is intermediary holding companies investments, that is B in C, investment of B in C, you should allocate among its shareholder. Who are the owners of B Limited? A Limited and NCI. Therefore, one portion will go to goodwill calculation and one portion goes to NCI. We have to subtract. These are the only 2 points which you need to keep it in mind related to chain holding as far as Ind AS 110 is concerned. So you compute the percentage of percentage, remaining is NCI, and then the intermediary holding company is there, intermediary subsidiary, you can call them both, B and C. That case, their investment you should allocate among holding company share in goodwill column and their NCI share in NCI column. That is the only point you need to keep it in mind related to chain holding problem. Shubham is telling, sir, then C is not a subsidiary. Yes, that is why I told you. For the assessment of holding subsidiary, there is separate discussion. I don't want to have it. For the purpose of examination, assume there is a holding company, because if they are not holding companies, 16 mark problem becomes waste, right? So it is assumed, it is given that they are holding company and we have to do consolidation. Whether they are holding company or not, it's a separate discussion that I don't want to confuse at this point in time. Okay, so I hope people are ready. Let's go to the chain holding problem. Okay, if you want, you can take a brief summary of this one. The chain holding, whatever I discuss, I have given you in the form of a chart. You can take a picture or something so that you'll get an idea about what to be done in case of chain holding problem. Ruchi Jain is asking, control is there even if it is less than 15% can be assumed. Yes, that's what I'm telling. You have to look at the circumstances. It may be, may not be. But in this case, for exam purpose, assume there is control. Okay. Hope you have taken a screenshot of the chart. Let us go for the problem. Multiple acquisition will come to slightly later. Let us go for the problem. I'll come to the multiple acquisition later. Let's go for the problem. Please read the problem once. This is a RTP question, MTP question. Sorry, then previous year question paper also. This was asked in your study material also. Prepare the consolidated balance sheet on 31st March 2002 of the group companies P Limited, S Limited, SS Limited. P for parent, S for subsidiary, S for sub-subsidiary. Nice name, no? Sub-subsidiary. The summarized balance sheet on the date are given below. Non-current assets, tangible assets, investments, current assets, cash in hand, bill receivable, trade receivable, inventory, equity liability, shareholders equity, reserves, retained earnings, current liabilities, trade payables, bills payable, P Limited, SS Limited. The following additional information is available. Uh, P Limited holds 80% shares in S Limited. S Limited holds 75% shares in SS Limited. Their holdings were acquired on 30th September 2001. The business activities of all companies are not seasonal in nature, and therefore it can be assumed that the profits are earned evenly throughout the year. On 1st of April 2001, the following balances stood in the books of S Limited and SS Limited, that is S Limited, SS Limited, reserves, retained earnings. Rupees 10 lakh included in the inventory figure of S Limited is inventory which has been purchased from SS Limited at cost plus 25%. The parent company has adopted accounting policy to measure non-controlling interest at fair value method. Quoted market price applying Ind AS 103. Assume market price of S Limited and SS Limited are same as their respective face value. So you got all the adjustments you're looking for. Many of you people were asking about NCI adjustment. Sir, solve the problem in NCI adjustment in your format. It has come. Chain holding is there. Fair value NCI is there. And unrealized profit adjustment is also there. So whatever you can think of, all adjustments are there in this problem. So AJ is asking, do we need to write that assumption in the exam? Not required. When you ask 16 marks, 20 marks question, it is implied there is control. No need to specifically write that. Okay, let's go for the solution now. First, let us analyze the structure. So we are having P Limited having some shares in S Limited, and S Limited is having some shares in SS Limited. What is the percentage? P Limited hold 80%. P Limited hold 80%. Then S Limited is having 75%. 75%. So how do you calculate the percentage? I told you, holding company share is in two methods. One indirect holding, other direct holding. That is P in S in SS, which is 80% multiplied by 70%, 75%. I think this comes to 60%. Then P in SS, that is not there, 0. So total 60%. Obviously remaining NCI share will be 40%. Okay, so 60% and 40%. That is one part. Then we have the concepts of the acquisition taking place during the year, right? Acquisition took place on 30th September, exactly 6 months. So we have to analyze the profits. So let us write analysis of profits of two companies we have to do. So let me do SS Limited, and then I'll go for analysis of profits of S Limited. Here, don't worry about revaluation, depreciation, unrealized profit. Whatever given in the problem, P&L, reserves, retained earnings. Only that part you take. Dividend paid, if any, you should add. Apart from that, don't do any adjustments while solving up to this point. Now, so here what do we do? What are the profits you are having? Let us do SS Limited. SS Limited reserves, retained earnings. So let us concentrate on SS Limited balance sheet. What is the reserves, my dear friends? Reserves is in the balance sheet 80. So reserves 80. We'll divide this into two parts. One is opening balance and other is current year. What was the opening balance? SS Limited reserves opening balance is 60, and therefore current year comes to 20. Now within 20 we have to do into two parts, 6 months up to September, after September, that is 30th September. So 6 months if I divide, my handwriting is not good, hope you are able to understand. Okay, similarly I'll come to retained earnings. As per the balance sheet, retained earnings as per the balance sheet is 60. From the balance sheet 60. This will divide this into two parts. One is opening balance, other is current year. What is opening balance of retained earnings? Here in the table given, 30. If opening balance is 30, current year is also 30. Divide into 6 months, which is 15, 15 each. Next come to S Limited. We'll start with reserves again. S Limited reserves in the balance sheet. Look at second column now. S Limited reserves is this number 100. We'll divide this into two parts. Opening balance and current year. Opening balance reserves. How much? Table reserves. Opening balance 80. 80. Therefore, current year is 20. Divide this into two parts, which is 10 and 10. 6 months, 10 and 10. Similarly, retained earnings. What is the balance sheet value? Go to the balance sheet, retained earnings of S Limited, this number 50. And this you divide into opening balance and current year. Opening balance as per the table given is this number 20, and balance comes to 30, divided equally 15, 15. Okay, then let us identify. See, opening balance is pre-acquisition, and in the current year, first 6 months is pre-acquisition and second 6 months is post-acquisition. Similarly, retained earnings, opening balance is pre, first 6 months is pre and second 6 months is post. Same thing, opening balance is pre, opening balance of current year, first part is pre, second part is post. Opening balance is pre, current year is, first part is pre, second part is post. So this is the analysis of profits relating to subsidiary company as well as sub-subsidiary company, dividing the profits on number of months basis. Okay, so hope you done till here. Now let us go for the working note format. Any questions, my dear friends, till here? Okay, let's go further then. Okay, working note let us do. Let us start from SS Limited. Okay, start from SS Limited, where we write share capital 320, 60% goes to goodwill, 40% goes to NCI. And then we have analyzed reserves, opening balance 60, 60% goes to holding company share, goodwill, 40% to NCI. Current year 10-10. First part is pre, second part is post, same thing with retained earnings. So I'm giving you the calculation directly. Please check out and see if you are able to solve it. I'm doing a zoom. Hopefully you're able to see the numbers as well. But if you write it on your own, you'll get a better clarity. Anjali S is asking, what if date of acquisition of S Limited, SS Limited different dates? Even then, the solution remains same. Only point to be kept in mind is we have to take whichever is later, A in B or B in C. Because if you want to take A in C, that point in time, you should know when the control is coming into existence. That is when A takes over B or B takes over C, whichever is later. Whichever is later, that date, same calculation, no change. Only the date you have to be careful. But I don't think they will ask you that part in exam, because this itself is, students are finding it too difficult to answer it. So till student answer these questions, I don't think institute goes to next level. Anyway, I told you the answer. Okay, so dear friends, before we go further, is there any adjustments under SS Limited we should do before we go to S Limited? Is there any adjustments? Can you please identify? If yes, please have a comment in the chat section. Yes, pre and post segregation also depends on the later date. Yes, it is. That is the purpose of identifying the date. Okay, some of you are telling unrealized profit on stock. Is it so? Who is the seller? Let us identify. Who is the seller? It's include inventory figure of SS Limited, purchase from SS Limited, purchase from SS. So seller is SS. You should always think from seller point of view. Who is the seller here? SS Limited. And we are discussing SS Limited analysis. Therefore, we have to consider unrealized profit. Okay, let's go for the unrealized profit adjustment. Okay, unrealized profit adjustment. Unrealized profit is given 10, but they've given 25% is on cost. But we should convert it to sales figure, right? So on cost into sales means it is 25 by 125. 25 by 125. So 10 into 25 by 125, you get to subtract in con PL column, subtract in NCA column, 60%, 40%. We are taking in the books of seller SS Limited. SS Limited. Okay. Any other adjustments, my dear friends? Any other adjustments? I think some of you are answering NC adjustment. Yes, I think many of you are waiting for this adjustments, I believe. Many of you have made a request for this. I would like to address that. This can come in chain holding problem like this, or this can come in any problem where NCI is measured at fair value. I repeat, NCI is measured at fair value. Let us read that point once more. What does they say? The parent company has adopted an accounting policy to measure non-controlling at fair value. And what is that fair value? How much is fair value? How to compute fair value? They said you assume it is quoted market price. But what is market price? They have given information. Assume. Please read. Assume the market prices of S Limited and SS Limited are same as their respective face values. So fair value, they said equal to market price, and the market price is equal to face value. Market price equal to face value. That is their instruction. So we have to follow it. So Katyavan is asking, sir, kindly explain step acquisition if possible. I'll come to it. I've solved full-fledged question yesterday, and now I'm solving chain holding problem. I'll be solving concepts related to step acquisition and concept related to the disposal. I will be covering it. Don't have any worry about it. Okay, let's go further. Okay, now okay, so we have to compute the fair value of NCI and the proportionate net assets. Proportionate net assets means what? Whatever share capital plus pre-acquisition profits. I will simply call it as book value. Instead of calling proportionate net assets, I will simply call book value of NCI. Why? Because see, net assets taken over. Once it is taken over, it is recorded in the group books. Group books means book value. So for simplicity's sake, I will use the word book value of NCI, compare it with fair value of NCI. Please observe, my dear friends, book value of NCI is as on date of acquisition. Can you tell me once more? What is that? Book value of NCI as on date of acquisition. So here, what are the things that will come as on date of acquisition? You will get 128 because share capital is date of acquisition, reserves 24 as on date of acquisition, current year profit first half as on date of acquisition, retained earnings 12 as on date of acquisition, and profits up to on the date of acquisition. That is, the profits in the second 6 months will not come, and profits in the second 6 months will not come, unrealized profit will not come. So these are the elements which are there at the time of acquisition. NCI at the time of acquisition, share capital, pre-acquisition profits, revaluation profits, fair value adjustments. These are the things which are there at the time of acquisition. What are not there at the time of acquisition? Depreciation on revalued amount, unrealized profit, dividend paid. Those things should not be considered. Okay, so please add all these numbers now. 128 plus 24 plus 4 plus 12 plus 6. Can you tell me the total amount, my dear friends, how much it comes to? What is the total of this? 128, 24, 4, 12, 6. Okay, I'm getting 174. Okay, now 174 is the book value of NCI, right? 174 is the book value of NCI. But what is the fair value? They said fair value, take it as face value. What is face value? 128. Face value is 128. Book value is 174. So what is the difference? The difference is 46. And what we should do with respect to 46? Please focus. Please focus. Fair value 128, book value 174, fair value is less. Fair value is less. Therefore, I should subtract it in NCI and add in goodwill. I should subtract in NCI and add in goodwill. Why should I subtract in NCI? Because NCI is already now having book value. What is book value? 174. But what is supposed to be fair value? From 174, I have to come down to 128. If 174 should come down to 128 means what should you do? Subtract. Simple technique. Don't think much. If fair value is more, add in NCI. Opposite in goodwill. If fair value is more, add in NCI. Opposite in goodwill. If fair value is less, subtract in NCI, opposite in goodwill. So whatever treatment you want to do it in NCI. Fair value is more, add in NCI. Fair value is less, subtract in NCI. Okay, so did you get this number adjustment, NCI adjustment? Many of you are asking for it. Should I explain once more? Please take 1 minute and understand yourself. Got this, my dear friends? Shall we go further? Explain once more. Okay. First, NCI adjustment. Just follow 3 steps. NCI adjustment, 3 steps. First adjustment. Compute book value of NCI. What is book value of NCI? NCI share in share capital and pre-acquisition profits. Book value of NCI, that is share capital and pre-acquisition profits. Compare it fair value of NCI, find out the difference. Book value of NCI on the date of acquisition, fair value of NCI on the date of acquisition, find out the difference. The difference, I mean, if fair value is more, then the difference subtract in NCI. If the fair, okay, let me write it down just for more clarity. Let me do one thing. I'll give a quick thing. So NCI adjustment. If you want, you can write it down. Compute book value, which is equal to share capital plus pre-acquisition profits plus fair value adjustment like revaluation profits, all related to NCI. Remember, okay, NCI percentage. Then compare it with fair value. Then you find out the difference. Okay, now what you're going to do, 2 scenarios. If fair value is more than book value, then plus in NCI, minus in goodwill. If fair value is less than book value, like in this case, you do minus in NCI, plus in goodwill. Simple. book value, fair value, difference. If fair value is more, then you do plus in NCI, minus in goodwill. If fair value is less, minus in NCI, plus in goodwill. Hope you got this chart better clarity now. Please confirm. Okay, very good. Now let's go further. Now related to subsidiary company, that is S Limited, share capital, reserves, retained earnings, amounts. So same what you can write it down related to S Limited. So please write it down. S Limited. Rangesh Padri is asking, sir, how fair value of NCA is 128? They said fair value equal to face value. What is face value? Share capital. What is share capital? Share capital is 128. This is no, share capital is face value only. No, 128. So 128 I have taken. If they have given some other market price, I would have taken number of shares multiplied by market price. They said face value. Face value is share capital. So I have taken 128 as the number. Hope you got that clarity. Okay, fine. So please take it down related to the S Limited. I hope S Limited is not a problem. We already computed these numbers. Share capital 400, 80%, 20%. This is again, don't take the previous percentage. Okay, this is P Limited in S Limited. Simple, 80%, 20%. So opening balance, we have done the chart. Then current year, first half is pre, second half is post, 10-10. And opening balance retained earnings is pre. And again in the retained earnings, first half is pre, second half is post. So take it accordingly. Pre-acquisition comes in goodwill column. NCI will get their share anyways. Post-acquisition comes in ConPL column. NCI will get their share anyways. Okay. Can you tell me any other adjustments in S Limited? Any other adjustments in S Limited? Okay. Dear friends, can you try this here? What is the NCA adjustment? We have done NCA adjustment for SS Limited. Can you try the NCA adjustment for S Limited here? What is the difference comes to? So NCA adjustment will come. One more investment will come. Inventory value I have taken, my dear friends, already. So inventory will not come again now. Okay. Now, what are the things to be considered, my dear friends? Share capital will take 80, opening balance 16 will take, the first half profit with 2 will take. This 2 will not take. This opening balance of retained earnings will take. Current year balance 3 will take. Post acquisition will not be taking it. So that total will come to 105. And what is fair value? They said book value, and book value is 80. So difference is 25, and because that difference is negative, meaning fair value is less. Since fair value is less, subtract in NCI column and add in goodwill column. Subtract in NCI column and add in goodwill column. So hope you are getting the 20 number 25, all of you. Okay. Then regarding investments, I told you investment of subsidiary S Limited, investment S Limited, investments S Limited value is 280, but that 280 is owned by two sets of people. One is P Limited holding company, other is outsiders, which is 20%. So 280 divided 80% goes to goodwill calculation, 20% goes to NCI calculation. Subtract investments, please subtract in those two columns. Okay, and after that straightforward, P Limited investments will come, P Limited retained earnings will come, and P Limited's reserves will come. So P Limited's reserves will go to ConPL, P Limited retained earnings will goes to ConPL, investments of P Limited goes to goodwill. So please do the total, tell me what do you get. Please do the total of 3 columns. Okay, I'll do zoom out, but the numbers will be very small. I don't know whether you can see those numbers. Numbers are very small. Okay, so total will come to 188. That is goodwill column. Then the second ConPL 373.8 and NCI 166.2. But in the exam, you have to write both of them. Positive number means actually it's not a goodwill, it's a capital reserve, gain on bargain purchase, capital reserve. So you should write OCI as sum of these other equity as sum of these two, 188 plus 373.8. 180, 160, Atul is asking what is 180, 160? Retained earnings reserves of P Limited, holding companies reserves, holding companies profits, that will come in ConPL. Okay, so hope you got this one. Just for more clarity, I'll do one thing. This working note, what you're seeing now, the screenshot of this, I will share in my Telegram group, Telegram channel. I will share this. So later, you can view it and you can verify your answers. Okay, so investment amount from the balance sheet, investment is 340, holding company's investment 340, holding company's investment 340. Kanushka is asking, so can you quickly run through investment once again. There are two investments that you need to consider. Investment by P Limited, holding company investments, that is 340, is subtracted in goodwill column. Then the S Limited subsidiary is there. S Limited subsidiary, that intermediary subsidiary, they are having investments. Their investments should be divided among holding the company share 80%, NCI share 20%. Okay, for those who wants to zoom in a little bit, this is related to S Limited and parent P Limited. Okay, so anyway, as I told you, I will share this screenshot of this solution in the Telegram channel. In my Telegram channel, you will get the clear picture. You can compare it. Okay, hope you got the things conceptually. Balance sheet, you can try it later. I will share the solution again in my Telegram channel later after the session is over. I will share the screenshot of this working note, as well as I'll share the screenshot of the balance sheet. Okay, but before we go to the next concept now, any questions related to doubts? Any doubts? Priya is asking adjustment of URP in case of sale by S Limited. We have taken. We have taken URP on stock. Sale is not by S Limited. Sale is by SS Limited. Purchased by S Limited, right? Sale is by SS Limited. So we have taken SS Limited sale, unrealized profit, we have taken. But can you imagine entire working note in one page, one slide? I know this font is small, but entire everything is in one page. Entire thing. You don't have to confuse yourself at all. Okay. For the total, GBP is 188, ConPL 373.8. We have to sum these two in the balance sheet, and 166.2 is NCI. Okay, hopefully at least you got the confidence to read the question on consolidation. Any format, any question you can solve in this format. I will assure you, I will guarantee. You get marks, have no doubt about it. Okay, any points, my dear friends, in chain holding? Now we'll go to multiple acquisition and then we'll go to the disposal. Okay. Okay, hope you got it amount. Anyway, if you're not able to get the amount, like if you're not able to see, as I told you, I've shared the screenshot, you'll be able to compare it. But I hope you got the concept, overall view, the calculation methodology right. That is important. Numbers, you can always adjust it and it will change in every problem also. But the concept, underlying principle, hope you're able to get it. Okay, let's go further. Balance sheet, I'll share it in the group. You can try it later. Okay, let's come to multiple acquisition. So far, is things clear, my dear friends? Please confirm. Okay, very good. Let's go further. Multiple acquisition. Multiple acquisition is basically covered by, again, Ind AS 103, more than Ind AS 110. So multiple acquisition will have two scenarios. One scenario, I will take an example directly. You acquire 60% first and 10% later. And second scenario example, I'll take 40% first, 30% later. You see, in both cases, you're having 70% and 70%. So what you should do in this case? You should identify when the control is coming into existence. Control, in this case, let us take the shareholding. In the first example, control came into existence in the first case, 60% itself. So this is a add-on. Okay. Now in the second case, the 40% don't get the control, 30% you get the control. So only in the second case, you get the control. So in the first case, in the first acquisition itself, you got the control, and in the second case you got in the second percentage. So only when you got the control, only from that point onwards the consolidation applies. Now this consolidation is started at 60% itself, but when you acquire 40%, there is no consolidated financial statement. But when you acquire 30%, you have to prepare consolidated financial statements. So the first example, in the first acquisition itself, you prepared consolidated financial statement and then you acquired more. So when CF is prepared, goodwill is already calculated. So this 10% acquisition, you have to account it as equity transaction. And in the second case, 30% acquisition, that is when you are going to account for the acquisition parts. Okay. Now before I go to the further details, did you get the clarity here? In the first scenario, you got the controlling interest, then you acquired extra. In the second case, first you got 40%, no control, then you got 30%, that is when you got the control. So in the first example, first acquisition, consolidation is prepared. In the second example, in the second acquisition, consolidation is prepared. Hope you got the scenario correct. Okay. Now, what will happen? In the first case, because you got 60% control, 40% is NCI. When you acquire 40% more, 10% more, what will happen? In this example, first acquisition, holding company share is 60, NCI share is 40. And on second acquisition, you acquired extra 10%. From whom you acquired? From existing shareholders. and existing shareholders, they will sell it, means they will become minus 10, therefore yours becomes 70 and theirs becomes 30. So you have to account for this change. Holding company share will increase and NCI share will decrease. So what journal entry you have to pass? Journal entry NCI decreasing, so NCI account debit, and how holding company is getting an benefit, NCI account debit to bank, and differential amount, either profit or loss, will be transferred to other equity, reserves and surplus. That's all, nothing else. So in case of first acquisition is already there, subsequently you acquire more, what is going to happen? NCI share will reduce, so NCI is debited. And how holding company gets this 10%? By paying purchase consideration, by paying cash, that is to bank. Differential amount may be profit or loss transferred to other equity, that is in our column, ConPL column. Hope you got that point related to the first point. Now second point, what will happen? Second point, you are acquiring subsequently. No, you're already having 40%, that means you're already having investment. Now that investment when you acquired, let's say it was 80 crores. Now as on 30%, please focus here, when the control is obtained in stages, when the control is obtained in stages, when the control is obtained in stages, on the date of control, the previous acquisition should be remeasured, revalued at fair value. Meaning if 40% at 80 crore when you paid, now on the date of control 30% acquired, this fair value 80 became 82 crores. So the 2 crores fair value measurement should be transferred to P&L account. So in the first case, NCI decrease, holding company share will increase by way of a payment. The difference should go to other equity, not to P&L, reserves and surplus basically. In case of second thing, a control acquired in multiple stages, previously acquired investment should be revalued and the differential amount should be transferred to P&L account. There's a very beautiful logic behind this, but those things I cannot go in depth at this point in time because we have a time constraint. So hope you got the conceptual clarity on the multiple acquisition of two scenarios. One scenario, first acquisition you got the control, then you acquired extra, NCI will reduce, your holding company share will increase, difference goes to other equity. In the second scenario, you acquire over a period of time and then you get the control. So on the date of control, the previously held assessments, previously held investments should be revalued, should be taken at fair value. It is asking, can you repeat the second case? Okay, I'll take the second case once more. Suppose you take the percentage like this, 30%, you paid 30 crores. 40%, let's say then you acquired 10% where you paid 12 crores. Then you acquired 30% more where whatever the fair value got it. So on this date, you are getting the control. So what you should do, this needs to be revalued. The cost is 42, 30 plus 12 and the revalued amount, let's say it comes to 48. So 6 rupees profit should be transferred to P&L account. In case of multiple stage acquisition, the previously held investments should be revalued and difference between the cost and the fair value should be transferred to P&L account. Hope you got the points. On the revalued amount of previous investment, the difference will go to other equity. No, on the revalued amount, it will go to P&L account. In the first scenario, it will go to other equity. In the second scenario, investments acquiring, it's like investment sold. That is the scenario you have to apply. As if that investment is sold now at fair value. That profit should go to P&L account. Even if it is invested value to FVT OCI, no, FVT OCI means it will go to OCI. Yeah, it will go to OCI, not other equity. Either it will go to P&L if it is FVTPL, or if it go to FVT OCI, FVT OCI, not definitely to other equity. Other equity, not directly, it will go to OCI. That is true. OCI is understood, correct. Okay, so hope you got this point now. This is the case of multiple acquisition. Let's go to next scenario of disposal. Disposal, sale. Now related to sale, there can be outright sale. Outright sale means entire thing is sold, control is lost. In that case, what you should do? Sale consideration, you should take it amount, bank, it's like bank account debit. Journal entry will be like bank account debit. Then NCI on the date of sale. NCI will have a credit balance. Now to be de-recognized, that should be taken out from the books. So NCI account is also debited. Goodwill will have a debit balance. That should be de-recognized. So that will be subtracted, means it will be to goodwill. Now net assets of subsidiary company will have a debit balance, all the assets minus liabilities. Now that should be taken out, that should be sold, so it will also be subtracted, that is to net assets of subsidiary. Any differential amount comes, that will be transferred to P&L account as a profit. Okay, next, this is loss of control. What is loss of control? You had 100% or you had 80%, you sold entire 80%. Continuous subsidiary means you had 80%, but you sold only 20%. You sold only 20%. Remaining 60% you continue. Remaining 60% you continue means you continue to have control. You continue to have subsidiary. If subsidiary is continued, no need to de-recognize NCI. No need to de-recognize goodwill. No need to de-recognize net assets. But what will happen? When you sell, holding company share will decrease. The outsiders who NCI share will increase. That account need to be done. Therefore, you are going to pass an entry, that is bank account debit to NCI, and differential amount may be profit or loss transferred to other equity, may be transferred to reserves and surplus. Okay, it is just like the way what you had in multiple acquisition, opposite. In the multiple acquisition, holding company share increased, NCI share decreased. In this example, in this illustration, reverse, holding company share reduce, the NCI share will increase. Okay, that's all, very observable. This is interesting. You sell, but you continue to show it as associate. For example, you had 80%, you sell 50%. 30% you continue, so you continue to show it as associates. You can't completely de-recognize. In such case, goodwill should be de-recognized, net assets should be de-recognized, then NCI de-recognized, sale consideration de-recognized. All these points will apply, but one extra point will come, that is fair value of equity continued, that will be debited by way of investments. Okay, and otherwise again the difference will be transferred to P&L account, just like an outright sale. These are the various scenarios. If you want, you can take a picture of this chart. We will do some problems relating to these points now. Okay, last one, please explain once more. Okay, no problem. Suppose you are having 80%, you sell, let's say 50%, you continue to have 30%. Now, for 50% sold, you get bank amount you receive, that is 50%. You have not sold 30%, that means that will be now to be classified as investment in associates. Then what is 20%? As on this date, NCI, that should be derecognized, so NCI account debit. 2, what should happen? To net assets is derecognized, to goodwill is derecognized, profit or loss, you transfer it to reserves and surplus, you recognize profit or loss. So 50% sold, 30% unsold, transfer it to investments. NCI, whatever is there, take it out, derecognize, you're no more a holding company, no more NCI. And net assets, you're not holding company, you cannot take their net assets. Goodwill cannot be there because it is no longer a subsidiary. So same thing as the previous one, except that this fair value of what is retained will come as an extra thing. Okay, if you want zooming, this for the first part, outright sale. Then continuing subsidiary, then continuing is as associate. 30% will be at fair value. Yes, yes, 30% investments will be at fair value. Yes, yes, you're right. Whatever the rate you have taken for bank, same rate you take it for investments, fair value. Okay, so we have done this part. Let's go further to problem number 3, which is having all these elements. Question number 3. As at the beginning of its current financial year, AB Limited holds 90% of equity interest in BC Limited. During the financial year, AB Limited sells 70% of equity interest in BC Limited to PQR Limited for a total consideration of 56 crores. Consequently, loses the control of BC Limited. So you had 90%, you sold 70%, so remaining you will have 20%. This will fit into our last category. This is where many of you are having the doubts. We are doing a problem. And consequently loses the control of BC Limited. On the date of disposal, fair value of the 20% interest retained by AB Limited is 16 crores. This 20% retained is 16 crores. And the net assets of BC Limited are fair valued at 60 crore. Net assets amount to be derecognized, 60 crores. The net assets include the following: debt investments classified as fair value through other comprehensive income, FEOCI of 12 crores and related FEOCI reserve of 6 crores. Net defined liability of 6 crores that has resulted in reserve relating to remeasurement losses 3 crores. Equity investments considered not held for trading, that is basically FETOCI, for which irrevocable option of recognizing the change in fair value FEOCI has been availed and related FEOCI reserve of 4 crores. Net assets foreign operation of 20 crores, related foreign currency translation reserve of 8 crores. In consolidated financial statements of AB Limited, 90% of the above reserves were included in equivalent equity reserve balances, with the 10% attributable to non-controlling interest included as part of carrying amount of non-controlling interest. What would be the accounting treatment of loss of control in the consolidated financial statements of AB Limited? Please read the question once more for 2 minutes. Balakrishna is asking, sir, can you post in Telegram channel? Yes, the disposal chart, I will post it in the Telegram channel. Okay, hope you read it. Let us solve it now. Okay, first let us do holding summary. So present holding 90% holding company, and NCI will be remaining 10%. Sold 70%, so retained 20%. So you will receive amount bank for 70% shares, and you have retained. Retained means you will go to investments at 20%. Then what will happen to NCI? Because you have lost the control, you need to close it. You need to de-recognize it. That is NCI 10%. So bank account debit, what are the values? Bank you have sold for, on the date of disposal, fair value of retained 16 crores, and sold for a consideration of 56 crores. So sold for 56 crores, retained 16 crores. And what is 10%, which is NCI? That is whatever the net assets existing value. So 2 net assets. Ideally we should have written 2 goodwill, no information on goodwill, so I will say including goodwill, then 2 NC, whatever the profit or loss. Okay, how much is net assets? Net assets of BC Limited, fair value of 60 crores, and 10% means that comes to 6 crores. So what is the balancing figure? Profit or loss? I think profit. The profit will be 2 P&L. Please find out the balancing figure. I think you get 18 crores. Please check the calculations. Is the amounts fine? Okay, good, got it. So this is one part. This is the regular part, that is you are having 90%, you sold 70%, control is lost, NCI is to be derecognized, goodwill to be derecognized, net assets to be derecognized. But you continue to have 20% control, that should be an investment in associates, you will continue to show it at fair value method. So far, no issues. Now let us take one by one adjustments. Debt investments classified as fair value through other comprehensive income of 12 crores, related FCI reserve of 6 crores. This is debt investments, 12 crores. Investments in the nature of debt of subsidiary company, and that is part of net assets. Net assets anyway we have derecognized. That means this 12 crore is closed. You got that? You don't have to pass an entry for debt investments. That is part of net assets. Net assets is derecognized. Therefore, the debt investments is also derecognized. Derecognized in the sense it is sold. Now for that we have to talk about Ind AS 109. Financial instruments in the nature of investments, debt investments, when it is sold, when it is derecognized, if it was classified as FET OCI, this has to be recycled to P&L account, recycled to P&L account. Therefore, this fair value reserve is there, 6 crores should be transferred to P&L. Very simple situation. If you are a person having investments in the nature of debt classified as FET OCI, you sell it, what will happen to its FET OCI reserves will be transferred to P&L account. That's what you would have done. Same thing, do it now. Whatever the reserve accumulated in OCI, FET OCI, because the asset is sold, it should be transferred to P&L, reclassified to P&L. But how much would be in OCI? You are a person having only 90% interest. So when that reserve was created, you have taken 90% to your OCI and 10% you have taken to NCI. You know the post acquisition profits CONPL column and the NCI column. So this 6 crores when created would have been transferred to your companies, that is holding companies OCI 90% and NCI portion 10%. Correct? So if you want to recycle to P&L account, you should transfer only 6 crores into 90%. So journal entry, additional entry will be, you are to transfer the FET OCI reserve account debit to P&L, not 6 crores, 6 crores into 90%, which is 5.4 crores. So you will get profit of 18 and you will get profit of 5.4 crores. Okay. So any doubt at this point till here? Atul is asking, can we compute NCI as fair value 8 crores? No, NCI you are not recognizing fair value 8 crores. Whatever the net assets you are having, that needs to be derecognized now. Fair value of NCI don't matter. NCI whatever you have now, that should be derecognized. They said net assets 60 crores. 10% is already shown in the book 6. So that is derecognized. Shubham is asking, can we make a consolidated entry? You can, but too many things will come in one place. If you can definitely go for it. Niranjan asking, can you repeat the debt point? If you are having investments in debt in the nature of FET OCI, if you have investment in the nature of debt, investments in the nature of FET OCI, when it is sold, the reserve portion, FET OCI reserve, should be transferred to P&L account. Same thing, do it now. You are having FET reserve of 6 crores on debt investments. Now that should be transferred to P&L account. You cannot transfer entire 6. The reason being 90% only you would have transferred. Balance 10% would have taken to NCI. So how much is your portion? 90%. Only that should go to P&L account. AJ is asking, adjustment is not clear. I am ready to repeat, but I want to know what is your doubt. Can you mention in few words that what is the what point you're getting confused so that I can explain it? I don't mind explaining it, but I want to know what is your clear pain point. Ajay asking, but sold 70% now. So 6 into 70%, 4.2. No, you have sold 70%. No, you have sold 70%, but you have to consider, you are de-recognizing the entire net assets, right? So since subsidiary company is sold, you have to assume entire your holdings is sold. Then, so what about retention? No, retention is investments. For investments, equity accounting will apply. There I don't worry about this OCI separately, NCI separately. So whatever portion which is being sold, whatever is de-recognized, that should be transferred to P&L account. Atul is asking, sir, instead of de-recognize based on net assets, can we de-recognize based on fair value? My doubt. No, you cannot. Whatever the book value you have, that should be de-recognized is NCI. Book value is 60. 60, 10% is 6 crores. That is de-recognized. It is not about measuring NCI. Please understand, Atul. It is de-recognizing whatever you have. You have 60. So 60 into 10% is as per books. So whatever is there as per books, that we are removing. Give me 1 second. It is asking, what about the balance of 0.6 crores in OCI? No, balance of 0.6 is not in OCI. Balance of 0.6 we have transferred to outsider share. It is in NCI. That NCI we are de-recognizing now. So no issues. I'll give you 2 minutes. Please think over it. I will explain once more as a summary part. But if you have any doubt, you can always ask. Actual balance in OCI is 12, but the date of sale it is 6. Now how are we recognizing it? Okay, Aishwarya, please read the question. OCI is not 12. Debt investment is 12. Reserve is only 6. Reserve is only 6. Kanushka is asking, which means 0.6 included in 6. Yes, 0.6. OCI related to NCI of 0.6 is included in NCI. Perfect. Yes, yes, yes. Okay, just as a matter of clarity, I'm giving you this debt investments, okay, is having carrying amount of 12 crores and FET OCI reserve is having carrying amount of 6 crores. This is part of net assets which is de-recognized at, what is the net assets? 60 crores. And this is de-recognized. This carrying amount of 6 crores is part of two elements, part of two parts: holding company share in the OCI and the NCI share in NCI of 6 crores. How much is holding company share total OCI? We don't know. This is derecognized, already part of NCI. This needs to be reclassified, or this needs to be recycled. How much? This 90% means 5.4 and 10% means 0.6. This 5.4 should be recycled. So from OCI account debit, that is FET OCI account debit, to P&L, we will be transferring 5.4. Okay, I hope you got the clarity now. Kanishka is asking, so we are passing entry now, how it's included in 6? I will not get the question. 6 is the fair value FET OCI, it's a reserve. That would have been transferred to holding company's OCI 90%, and that would have been transferred to NCI 10%. And 90% 5.4 is what we need to derecognize. I hope you got the clarity, my dear friends. Detailed chart. This chart I'll not be able to put it onto the group and all, so please write it down or take a screenshot. Dear friends, did you get the clarity now? Any questions still? In my question, why the entry is not OCI debit 6 to P&L 5.4 to NCI 0.6? NCI, okay, you are debiting OCI 6, but NCI, we have done this already, my dear friends. No, Kanishka is not getting your things clear. Let me do once more. On creation of FET OCI, what would have happened? Journal entry, what would have happened? In subsidiary books, what entry would have done? FET OCI investment to FET OCI reserve. FET OCI. How much? 6 crores. In holding company books or in group books, what entry you would have done? You would have done FET OCI 6.4 to FET OCI group books ConPL, consolidated P&L, or the group books 6 crores means 90% 5.4 to NCI 0.6. Now what we are doing? Now NCI 0.6 is debit, which is part of the net assets. How much is part of the net assets? 6 crores. And this 5.4 what is there, that is debited FET OCI account debit 5.4 to ConPL 5.4. Dear friends, are you getting the clarity now? Okay, let's do one thing. Should I repeat once more? Should we pass journal entry for more clarity? If you want a journal entry, please say yes, we'll pass the journal entry. Okay, let us do one thing. Journal entry. Okay, in subsidiary books on creation of OCI reserve. Investments to FVT OCI 6 crores. Okay, in group books during consolidation, FVT OCI subsidiary company 6 crores to, this is FVT OCI reserve. FVT OCI reserve of subsidiary company 6 crores to FVT OCI reserve of group 5.4 crores and 2 NCI 0.6 crores. Now on sale, FVT OCI of group 5.4 crores will be transferred to Con PL, that is group P&L, 5.4 crores. Now NCI is anyway derecognized, that you don't have to worry about it. Did you get the clarity now? Okay, nice. Then one question. What will happen in subsidiary books, this 6 crores? What will happen to this? In subsidiary books, what will happen? No answer? Yeah, in subsidiary books, no treatment, nothing. Correct, Kanishka, correct, Rangesh. As of now, no treatment. When it is sold by subsidiary company, then they will transfer this to P&L account. When subsidiary company sells, then in subsidiary books, they will transfer it to P&L account. But now what is happening? Holding company has subsidiary company has got investments. Now, because they're selling subsidiary, you have to account as if you're selling investments also. I'll tell you once more. So, holding company has subsidiary and subsidiary has got the investment. since you are selling subsidiary, you have to treat like you are selling investment also. Therefore, whatever the holding company had it in investment, that is transferred to P&L account. But what will happen to subsidiary now? They still continue to have investment. When they sell it, they will transfer it to P&L account when they ultimately sell it. Hope you got the complete clarity now as with respect to how the reclassification works. ಯಾವ ಇಂಟರ್ನೆಟ್ ಗೊತ್ತಾಯಿಲ್ಲ ಎಂತಕ್ಕೆ ಯಾವುದೂ ಗೊತ್ತಾಯಿಲ್ಲ ಬಂದಂಗಿದ್ದು ನೋಡಿ Okay, I think things are fine now. Okay, friends, is it fine now? Can I have a few yeses? Okay, good. So let us go to the second point now. Okay. Hope things are fine, better now. Okay. Now, second point, let's go for it. Second point. Net defined liability of 6 crores that has resulted in a reserve relating to net remeasurement loss of 3 crores. Now, remeasurement liability, remeasurement loss is not to be recycled. It will go to the reserves directly. It will not come to P&L account. The as per Ind AS 19. Okay, therefore, this 6 crores, the entry again, 6 crores would have been already included in net assets. Therefore, no issues with relate to that. Now, relating to this 3 crores losses, that should be transferred not to P&L, that should be transferred to other reserves or other equity. So, OCI to other reserves, let's say general reserve, not 6 crores or 3 crores, 3 crores into 90%, which is 2.4. Okay, one small point, this is a loss. So OCI would not have a credit balance, OCI would have a debit balance. So entry has to be reserve account debit to OCI. We don't transfer it to P&L account, we will transfer it to other reserves. Since it is a loss, we will debit the since it's a loss. Okay, so I'll just repeat once more. Remeasurement loss is remeasurement loss is not to be recycled. So instead of transferring it to P&L account, you transfer it to other reserves. Normal journal entry should be like the previous one. It should be OCI account debit to other reserves. But this is a loss. Therefore, it will be, the journal entry will be other reserve account debit to OCI remeasurement. Okay, remeasurement OCI, remeasurement reserve, which is 3 crores into 90%, which is 2.7 crores. I hope this point is clear, my dear friends. Is it fine? Remeasurement loss is not to be reclassified to P&L, therefore it should be transferred to other reserves. If it was a profit, the entry would have been OCI account debit to other reserves, but this is a loss, so entry is reverse. Loss, OCI will have a debit balance. Now you need to do a credit balance. Therefore, OCI account debit to other reserves. That is OCI account debit to other reserves. Is this point clear? This will not go to P&L account. Please confirm it yes. If you have any doubt, let me know. Okay, good. Let's go to third point then. Equity investment considered not held for trading 10 crores, for which irrecoverable portion of recognizing the change in fair value of OCI have been availed and related OCI reserve of 4 crores. Now 10 crores is part of net assets, is already derecognized. No need to pass any specific entry. Now FE OCI reserve of 4 crores is not to be recycled to P&L account. Not to be recycled to P&L account means it should go to other reserves. So relating to this, so FET OCI reserve, which is OCI part, to not to P&L, other reserve. How much other reserves? Not 4 crores, only holding company share 4 crores into 90%, that is 3.6 crores. FET OCI 3.6 crores to other reserves 3.6 crores. So anybody is asking, why do we recognize it when it is sold? Because when it is unsold, it is an unrealized profit, so we don't take it to P&L. When it is sold, it becomes realized profit, so we take it to P&L. Hope you got that clarity. Will we go to the last point, D? Last point, D. Can we go for it? Can you confirm? Okay, let me go for last. Net assets of foreign operation of 20 crores, related foreign currency translation reserve of 8 crores. Now net assets 20 crore is already part of net assets, so that does not we are recognizing, so no separate entry. Now foreign currency translation reserve FCTR is an element of reclassification, therefore this should be transferred to P&L account. So FCTR account to P&L on sale. How much? 8 crores, not entire 8 crore, 8 crore into 90%, which is 2.7 crores. So we can say that FCTR account to P&L, it's a reclassification, so it will go to ConPL account 2.7 crores. So I think one point, only first point we spent about I think half an hour, but CDE, BCD you got the clarity easily. So we have passed 4 entries apart from that original one. So not 2.7, 7.2. Yes, correct. 7 point. Yeah, correct. 7 point. I think you got the point, right? So what you should do in case of sale with loss of control, in case of sale with loss of control, it should be transferred to P&L account. Goodwill should be derecognized, net assets derecognized, NCA derecognized, bank account is debited. In case of continuing some investments, that investment is also debited. Now in case of, if you have any other element, FET, OCI, if it is in other comprehensive income, check whether they are in the nature of to be reclassified or not to be reclassified. If it is in the nature of reclassified, it will be transferred to P&L to the extent of holding company share. If it is not to be reclassified, it is transferred to other reserves to the extent of holding company share. Not treatment for NCA share, because NCA share is already derecognized and it is an element included there, no separate treatment. Shubham Shai Ganesh is asking, what are the elements which should not be reclassified? This I have discussed yesterday. Okay. Okay, so Shubham Shaigan is asking, what are the elements which should not be reclassified? This I discussed yesterday. I have given you the list, I have given you the chart. What elements are reclassified, what elements are not reclassified. Please take a look yesterday's session at the beginning. If you are not able to find, please ask in the group. I will share the chart once more. Okay, so I hope you're fine till here. We have to do a problem on multiple acquisition in stages, that I will discuss along with Ind AS 28. Today only I will do it. I will do Ind AS 28, that is you are having associate like 30%, then you acquire 40% more, like that. How things are going to happen we will discuss. Okay, as of now this is regarding consolidation. Okay, let's go further now. Now, coming to Ind AS 111 joint arrangements, I will not be solving any problem. I will give you a brief idea about it. Okay, Ind AS 111 joint arrangements. First of all, you want to call it as a joint arrangement means there has to be a joint control. Joint control means collective control. One person cannot decide, two person together can decide. Okay, I'll give one scenario. Tell me whether there exists joint control or not. Okay, so in a company, A is a shareholder, B is a shareholder, D is a shareholder. A is having 30%, B is having 30%, C is having 30%, and D is having 10% in one company, total 100%. Now, does A and B have joint control? Can you confirm it? Does A and B have joint control? Can you please message in the live chat? Does A and B have joint control? 30%, 30%. Together they have 60%. So does A and B have joint control? Can A and B together said to have joint control? Okay. All of you are telling yes. I'm sorry. The answer is not necessary. That is why read one more thing. There has to be a contractual arrangement. So A is having 30%, B is having 30%. You can't say there is joint control. There has to be a contract between A and B. That what contract? That unless we both agree, we will not vote. So what will happen if A votes, B does not vote? No control. If A does not vote, B does not vote, no control, right? Therefore, there has to be a joint control with the form of a contract. Please observe this word. There has to be a contractual arrangement. Mere 30% and 30% cannot be said to be joint control. A and B having 30% each will enter into an agreement that unless we both agree, we are not going to say yes. That is, there has to be a unanimous consent between A and B. Then A and B together will make them as one, and we will call it as joint control. So hope you got that point, my dear friends. Mere joint percentage cannot become control. There has to be a contractual agreement between the persons so that together they can have a unanimous decision. That agreement need not be in writing, but that has to be some sort of control. It can be in articles of association also. The articles of association condition can say unless A and B both agree, it is not passed. The condition is not passed, decision is not taken. So control is in the hands of A and B. So mere 30% is not joint control. Together, if they have contractual arrangement, then it becomes a joint control. Okay. Then types of joint arrangements. We have joint operations where there is no separate vehicle. That is, for example, oil companies will lay down the oil pipes. There are expenses, and what oil companies they do, whatever expenses of that maintenance, they will share it. So oil pipe is not a separate company. It is an expense. It is an operation which is shared among the various people. There, you are one of the party. You can only be called as joint operator. You are just a part of it. You are not joint venture. Okay. Other points are there that will not go to it. Joint venture means separate vehicle, and the person is called as joint venturer. Okay. Now, What is the accounting? Accounting for joint venture, we apply specific accounting. What is specific accounting, or some people call proportionate accounting? If you own, like in this company, your share of expense is 30%, then whatever the expense amount, you will share 30%. Whatever income comes, you share 30%. Certain assets you might control 100%. Certain liabilities you might have 40%. All depends on the contracts. But joint venture means separate vehicle is arranged. So in joint venture, we are going to apply equity method of accounting. Are you able to get the difference, my dear friends? Difference between joint venture operations and joint venture entity. Joint venture operation means common set of transactions will happen, no separate company will be formed, therefore there we follow specific accounting, proportionate consolidation. Whereas under joint venture, separate entities formed, and there we follow equity method of accounting. Equity method, which is similar to the Ind AS, that is associates. For both associates and joint venture, we follow equity method of accounting. What is associate? Where you have significant influence. Normally we say significant influence means having 20% or more will be called as significant influence. Did you get the point, my dear friends? Joint control, joint arrangement, then associate. And for the joint venture and associate, we follow equity method of accounting. We will understand equity method of accounting, then we'll go for one problem. Any questions so far, my dear friends? Okay, let's go further. Let's go for the equity method of accounting. How does it work? It is applicable for joint venture, separate entity, as well as applicable for investment in associates. Equity method of accounting, you need to get some basics how you would have done in partnership form, little bit of IPCs and partner books. When a partner introduces capital, what journal entry is passed in the firm books for receiving the capital? Bank account debit to partner's capital. And what entry will you pass in partner books? He will have an investment in partnership firm, so investment account debit to bank. Okay, so for one person it is receiving amount, other person it is investment. And when partnership distribute profits, when the firm appropriates its profits, what journal entry will be passed? P&L account debit to partner's capital account, P&L appropriation account debit to partner's capital account. But in partner books, what entry you will pass? This is important and interesting. Please carefully observe. It is investment account debit to P&L account. Investment account debit to P&L account. That is income recognized on accrual basis. The partner will recognize the income from the partnership on accrual basis. Investment account debit to P&L accounts. Profit, loss means reverse. When profit is withdrawn by the partner, it's an outflow of cash. What entry the firm will pass? Partner's capital account debit to bank account. Now, what will the partner pass? He is receiving bank account debit. Can you tell me what will be 2? Will he transfer it to P&L account? When partner receive the share of profits from the firm, will he transfer it to P&L? Can you please Reply. When partner receive his share of profit, will it be transferred to P&L account? Will he transfer it to P&L accounts? No, because why? He has already transferred it to P&L account when it on accrual basis. So partners cannot recognize profit two times. You can recognize the profit either on accrual basis or on cash basis. You can't do both. Therefore, when he recognized already on cash or income basis, accrual basis, now you cannot transfer it to P&L. Instead, he will transfer it to investment account. He will transfer it to investment account because investment is already debited for accrual. Now you receive, you created, that will be taken care. So this partner books what you discussed is this what we did now called as equity method of accounting, and that is what is applicable for accounting for investment in associates, accounting for investment in joint venture when there is a separate entity. What is the nature of equity method? Equity method means investment account debit to bank. Investment account includes an element of goodwill, no separate recognition of goodwill. And when profit is earned by the associate, the investor will recognize on accrual basis investment account debit to P&L to its share of income. And when the amount is received by the investor from associate in the form of dividend, no pre-acquisition dividend, no post-acquisition dividend, it will not be transferred to P&L, it will be transferred to investment. Why it is not transferred to P&L? Because it's a matter of duplication. Why it is transferred to investments? Because investment is already debited for accrual, now you receive, so it is created, therefore investment is adjusted. No distinction between pre-acquisition dividend or post-acquisition dividends. Okay, now based on this, let us solve with this one problem which is related to investment in associates as well as related to multiple acquisition. Okay, please read the problem. On 1st of April 2001, PQR Limited acquired 30% of the voting ordinary shares of XYZ Limited for 8,000 crores. 30% acquired means PQR Limited accounts its investment using equity method as prescribed under Ind AS 28. On 31st March 2002, at the year end, PQR Limited recognized its share of net assets changes of XYZ Limited using the equity accounting as follows: share of profit and loss, share of exchange difference in OCI, share of revaluation reserve in OCI. The carrying amount of investment in associates on 31st March 2002 was therefore 8,000 plus 700 plus 100 plus 50 means 8850. On 1st of April 2002, PQR Limited acquired the remaining 70% of XYZ Limited. Oh, earlier 30%, now 70% for 25,000 crores. The following additional information is relevant at the date. Fair value of 30% interest already owned 9,000. Fair value of net identifiable assets 30,000. How much business should be accounted for? Please read the problem once more. Then we will discuss together. I don't think there's any buffering now. Things are clear from my side. Okay. Okay. So first we'll understand this will understand in three aspects. First aspect is relating to uh, accounting for associates. That is, you're accounting for uh, equity method. Then we'll account for consolidation. And because you're already having some percentage, this is a case of acquisition in multiple stages. Now, associates, what does this says? Accounted for 8,000 crores. On 1st of April 2001, you purchased for 8,000 crores. So, investment in associates 8,000, to bank 8,000. Then on 31st of March 2002, you have a share. So you have to account it on equity method, that is investment in associates. You will transfer it to various elements, to share in P&L account, to exchange difference in OCI, FCTR, foreign currency translation reserve, OCI, and revaluation reserve or PP, to revaluation reserve, that is again in OCI. Amounts are 700, 110, 700, 150, sorry, then 850. Therefore, what is the carrying amount of investment? Carrying amount of investment is 8,850. Okay. So, my dear friends, are you clear about the accounting for equity method so far? Sorry. Okay. So, hope you got it. Equity method. Now let's come to consolidation. What is consolidation? I told you earlier, when you acquire in multiple stages, previously assessed investment, previously acquired investment should be reassessed at fair value. For that purpose, what is the fair value they have given? The fair value they have given is uh, fair value of 30% owned 9,000, but what is the book value? 8,850. So revaluation of existing investment, revaluation of existing investment, that is investment account debit. 8,850 should become 9,000, means 150 to P&L 150. So that now what will happen to investments? Investments will become 9,000. Jitin is asking, sir, just asking, is there any specific reason for calling it equity method? Yes, equity method, because you are recognizing income on accrual basis. You are recognizing income on accrual basis, but you are not recognizing their investments. Equity method means recognizing it on income basis. But if it is a subsidiary company, you recognize it on income basis as well as you recognize their assets and liabilities. Net assets method, full consolidation method. So equity method is because you recognize it, income on accrual basis. That is the reason. Okay. Now this is revaluation of investment. Then you acquire balance 70%. That means now you are getting the entire control. So what is the entry going to be passed for acquisition? You will going to pass net assets, account debit. What is the fair value of net assets? Fair value of net assets 30,000. 30,000. Then to bank, what you paid for? You pay for 25,000. To investments, that is revalued amount, fair value, which is 9,000, and to NCI, if any. In this case, nothing is there, 0. Remember, bank you paid for 70%, investments, that is you are presently having 30%, and NCI 0%. Ultimately, these three numbers should add up to 100%. That is your control. If any NCI was there, like you acquired only not 70%, 60%, then 10% will go to NCI. That NCI will also be writing it. Now, balancing figure will become goodwill or capital reserve, as the case may be. So, in this case, how much will be goodwill? I think goodwill is 4,000, balancing figure. Goodwill, balancing figure 4,000. So, this is the accounting for associates. This is the accounting for consolidation. So, but associates becoming holding subsidiary company, this element should be reconsidered. What will happen to FCTR and what will happen to OCI? That is what we need to reconsider it now. Okay, so far are you clear? Any questions? Okay, good. Fine. Now what will happen? So far, now you have transferred to P&L. This no problem. This FCTR what we have, this revaluation reserve what you have, 150 is there, right? That should be now de-recognized. Why? Because you no longer associate. Now it has become subsidiary. So that OCI, that revaluation reserve should be closed. That should be not transferred, because as of now you are transferred to your reserves and your FCTR account. Just 1 second, give me 2 minutes. Just give me 2 minutes. Okay, now let me tell you this. What does Ind AS 103 says? Very simple treatment, my dear friends. Very simple, my dear, very simple treatment. This investment account you are revaluing, right? What is that logic? We have to account as if the investment is sold. We have to account as if the investment is sold. As if the investment is sold. Therefore, we have transferred to P&L account. Now, when investment is sold, this FCTR account and revaluation reserve should be de-recognized as if it is sold. Now, FCTR is in the nature of is in the nature of reclassification, and revaluation reserve is not in the nature of reclassification. Therefore, what we have to do now, additional entry to be passed on consolidation, additional entry for derecognition. FCTR, what will happen? FCTR account debit to P&L. This itself is their share only, so no need to multiply any percentage. FCTR account debit to P&L 150. And one more entry, this revaluation reserve is there. Revaluation reserve to other reserves is 50. So actually total profit and loss account, what will be reflected, 150 and 100. Total 250 will go to P&L account. That's what institute has given in one journal entry, but I am giving you in the form of a separate journal entry. That's all, very simple. In case of associates, existing investments should be revalued and difference should be transferred to P&L account. If there were any existing OCI in the nature of reclassification, that should be derecognized and transferred to P&L account. If OCI is not in the nature of recycling, it should be transferred to other reserves, or you can say retained earnings. So, in case of associate becoming subsidiary, there are two kinds of profits to be recognized. Profits on remeasurement of investments to fair value, and profits on account of recycling of OCI elements into P&L elements. Hope you got that clarity. Any question on this? This question and previous question, please mark it very important for this examination. This one and previous one, please mark it very important for this examination. Quite tricky, at the same time very simple. Easy 8 marker, 6 marker questions in exam. These are slightly tricky questions. Many students don't even attempt it. You have a good chance. Okay, any questions in consolidation so far? Because after this, I will go to business combination. Any questions? Ajay Chandra, yes, FCTR, is it same as recycle to P&L at the time of sale, like in earlier example? Yes. In that case, subsidiary company is sold, therefore derecognized FCTR to P&L. In this case, associate becoming subsidiary, so you have to treat like investment is sold, therefore FCTR to P&L account. Sir, is there any chance that cross holding will come in exam? No, cross holding in new syllabus, the institute has not covered anywhere, so don't expect that. Anju, the last part, can you explain once more? Last part, I'm not getting the last part. Can you tell which part last part means? Like A in B 65%, B in C 45%, C in A. No, cross holding, I told you it will not be asked because it involves simultaneous equations to be solved. That kind of questions I've not seen, so don't worry about examination point of view. Okay, my dear friends, So can we go to the business combination now? Ind AS 103. Atul sir, will you be taking common control? Yes, I will be taking one problem on common control Ind AS 103. Thank you, sir. Now getting confidence in consolidation. I hope that is my sincere objective is met, because consolidation is one hell a lot of things where many people are afraid to open the books. Reverse acquisition question, yes. Please download the notes. You'll get all the clarity and look at the questions at least. Profits on remeasurements and recycling. Okay, I'll repeat once more. When associate becoming subsidiary, or when subsidiary company is sold, what you need to do, you treat it like a sale of assets. You treat it like sale of assets and you de-recognize. Therefore, the OCI elements which was previously recognized now should be closed. OCI elements which was previously recognized now should be closed. How do you close it? Either you transfer it to P&L account or you transfer it to retained earnings, other reserves. To what extent? To the extent of the associate share or to the extent of holding company share, existing share, because that is what already transferred, now de-recognized. When will you transfer it to P&L? If it is recycling, it is in the nature of recycling. For example, FCTR or debt investment, FET OCI. In such case, whatever existing OCI will be transferred to P&L account, that is OCI with recycling. If it is OCI without recycling, it will be transferred to other reserves, retained earnings. But remember, in both cases, only to the extent of investor shares. For associate share. For subsidiary shares. Hope you got the things clear now. Okay, so I'll be solving all those varieties also. Let us go to next, that is Ind AS 103, business combination. First of all, let me tell you, many people might have this confusion. When does Ind AS 103 applies? When does Ind AS 110 applies? For that, you have the example here. Business combination Ind AS 103 applies. One second, one person is asking it down. Suppose in the question, holding company acquires 80%, then only 80% to be reserved from OCI. No, my dear friend, I'm telling, whatever investments you had already, that is de-recognized. How much investments you had? 30% you had. That 30% I will de-recognize. That is associate becoming subsidiary. If subsidiary company is sold, if subsidiary company you have 80%, then only 80% to be reversed. You are right. Hope you are very clear. Associate becoming subsidiary, meaning 30% is de-recognized. If subsidiary company is sold, control lost, that 80% is de-recognized. Hope you got that clarity. Okay, let us move on to Ind AS 103 now, business combination. Whenever entity obtains control, what is control? I talked about 3 points yesterday. That is variable return, power over investee, that is link between the power and the returns, those things. Okay, that point, those things you have to get a control. By acquiring net assets or by acquiring its significant equity interest. That is, A Limited buys out B Limited shares and B Limited is closed. Ind AS 103 applies. A Limited acquires a division of B Limited. Ind AS 103 applies. Net assets acquired, purchase consideration may be in the form of shares or may be in the form of cash. A Limited acquires 80% shares of B Limited. Will Ind AS 103 applies? Please comment. Ind AS A Limited acquires 80% shares of B Limited. Will Ind AS 103 apply or Ind AS 110 applies? Please reply. A Limited acquires 80% of B Limited. Ind AS 103 applies or Ind AS 110 applies? Okay, I think some of you are getting the questions. On the date of acquisition, Ind AS 103. Ind AS 103 is a comprehensive standard. You don't think from AS 14 point of view. AS 14 amalgamation, no, that is a small standard. Ind AS 103 is a comprehensive standard. It covers amalgamation, it covers acquisition by creating subsidiary, it also covers demerger, it acquires division. So merger, division acquisition, business acquisition, amalgamation, holding company, subsidiary company, relationship establishment, all covered under Ind AS 103. Then when Ind AS 110 will apply? Ind AS 110 apply for subsequent measurement, subsequent reporting. For example, on 1st of January 2019, A Limited acquires B Limited 80%. Ind AS 103. On 31st of March 2020, financial statements are prepared, subsequent measurement, then Ind AS 110 applies. Hope you got the basic clarity. On the date of acquisition, Ind AS 103. Subsequently, Ind AS 110. So what we discussed yesterday, goodwill under fair value method, goodwill under proportionate method, all these things are given in Ind AS 103. Multiple acquisition, when acquisition happens in multiple stages, you have to previously held investment should be reassessed and difference should be transferred to P&L. Ind AS 103. So initial recognition at the time of acquisition, Ind AS 103 applies when the control is obtained. Subsequently, on balance sheet date, Ind AS 110 is applied. I hope you got that basic clarity right. Now, one more important point. It has to be a business combination. One important principle is control, other important is business. There has to be a business in place. Business means capable of generating profits. That's all, very simple. It may be input, it may be process, it may be output. It may be a department, it may be a research and development department, it may be set of operations, it may be set of units, it may be outlet. No restrictions, as long as that thing what you're acquiring is capable of generating business, that is capable of generating profit on its own without dependency, then that is called as business combination. Sometimes what happens, one small company takes over big company for the purpose of taxation benefit, or for the example, A Limited acquires B Limited, who is a complete loss making company, no activity for 3 years, last 3 years no activity. And why will you acquire B company? They have some assets which are scrap value assets and they have some loss, so you can set off. So intention of A Limited acquiring B Limited is not to do the business of B Limited. What is the intention? They have some scrap value assets, they have loss, I would like to use it. So I'm not taking over business, I am taking over the assets. Ind AS 103 don't apply. Okay, so one of the question is asking, sir, if A Limited acquire one division of B Limited, is also covered under business combination Ind AS 103? Yes, as long as that division is capable of generating its own business. For example, there is one HR department, human resource department. All the employees of human resource you take over, they are not profit making. That division is not Ind AS 103. On the other hand, a company has food division, a retail division, a sports division. You take out sports division, that is capable of generating profits on its own, that is capable of generating business on its own. Ind AS 103 will apply. Okay, this is basic application. Coming to steps. Okay, coming to steps, the standard says first you have to identify the acquirer, then the date of acquisition, identify the assets and liabilities, then compute the goodwill or gain on bargain purchase. That's what institute says, but I will come to this point. First, you always compute purchase consideration, that is amount paid, amount which is paid in the form of cash or shares. Then you compute net identifiable assets, or I will say net assets taken over. The difference will be goodwill. And one more working note will be how PC is discharged. So please follow these 4 important working notes while doing business combination problems. Purchase consideration, what is payable going out. Net has taken over, what is coming in. Double entry system, simple. Purchase consideration, what is going out. Net assets, what is coming in. And this standard says this net assets should be always taken over at fair values. So purchase consideration is amount paid, net assets taken over, what is coming in. If I pay more, that difference is called as goodwill. If I pay less, it's called as capital reserve or gain on bargain purchase. And when I'm paying purchase consideration, in what form it is paid? In the form of cash, in the form of shares, in the form of share capital, in the form of security premium, in the form of debentures, in the form of ESOP reserves. So many forms of settlement of PC will be there. It's just a working note, so that in the full-fledged balance sheet you will get to know where, under which heading this will be considered. The manner in which purchase consideration is discharged, to know the breakup of share capital, security premium, cash, debentures, and so on. So if I know the individual breakup elements, when I prepare full-fledged balance sheet, this will be a good working note. Okay, it's only for a convenience, there is no rule as such. ESOP treatment, I will come to it, don't worry. Okay, now identifying the acquirer, there is a difference between AS 14 and Ind AS 103 here. Legal acquirer is may be different from accounting acquirer. For example, A Limited acquires B Limited, A Limited is acquirer, no doubt. But A Limited and B Limited is forming a new company called as C Limited. So C Limited is the acquirer legally, but to be able to called as acquirer, you should be in existence first. But C Limited is not in existence, it's newly born baby. How a newly born baby can acquire anybody? Not possible. So even though C is a legal acquirer, we have to make either A or B as accounting acquirer. Now who is accounting acquirer, A or B? Depends on who has more control. If A obtains 60% control, B obtains 40% control, then A is called as the accounting acquirer and C is called as the legal acquirer. Okay, now one more situation you understand. Company A has got 100 shares. They acquired B, and for issuing they issued 200 shares. So totally after merger 300 shares. So what does A position after merger will be? Only 1/3. What is B's shareholder? Once they join A company, they become 2/3. Even though A is accounting, even though accounting acquirer is A, sorry, even though A is legal acquirer, But because of the control, who has control actually? B shareholder has got the control. So B company becomes the accounting acquirer because they got the control. This is a typical case of reverse merger. How to solve reverse merger? I'll do a problem later. You'll get to know about it. Okay. This then, while solving the full-fledged problem, what points to be kept in mind? I'll give you a quick summary of it. So while solving problem, you can keep these things in mind. Acquirers always taking over at book values because acquirers cannot revalue. If A limited takes over B limited, A limited book value will remain same, B limited will be taken over at fair value, but A limited acquirer, the asset and liabilities will continue at book values. Share capital of acquirer will increase. Why? Because you issue shares, share capital will increase. What about other reserves? The acquirer's other reserves will continue. Reserves and surplus, OCI, P&L account, general reserve, everything will continue. That is acquirer part. Acquiree, the company which is being closed, that person, assets and liabilities will be at fair values. Share capital not taken because we are increasing by share capital issued. So issued share capital is considered, not existing share capital. Reserves of acquiree is not taken over. They will get we will take over only assets and liabilities, not reserves. Okay. Now between these 2 points, these 2 columns, any point I need to explain, please ask. Okay, so this point, now one point to be kept in mind, after merger, I'm taking from the full-fledged prawns point of view, new elements will arise. What are those new elements? Security premium, shares issued at above face value, that will come as an additional element. Capital is our goodwill, difference between PC and net assets taken over. And if the existing company revalues its assets, revaluation reserve also will come as an additional element. Okay, so you may take down these points, or you can take a picture of this. Acquirees portion, acquiree means the target company, which is being taken over. Acquirees assets and liabilities are taken over at fair values. Okay, share capital of acquiree is not relevant because if A takes over B, B share capital is not important because A will issue its shares, that anyway have considered here, that is increased by shares issued. So share capital is ignored. Reserves, the target company which is getting closed, amalgamate company, vendor company, their reserves will not come to new company, their P&L will not come to new company, so that is being cancelled. So only what is taken over is assets of amalgamated company, liabilities of amalgamated company, and that is at fair values. In replacement of their reserves and their capital, we will be issuing their shares, so our share capital will increase, and we'll be issuing shares at a face value, over and above face value, security premium will come. Okay, so this is the point relating to the acquirees portion. Okay, so hope you got these points, my dear friends. These are the basics of Ind AS 103. There are special points of Ind AS 103 like contingent consideration, deferred consideration, direct cost, issue of land as consideration, then ESOP treatment, measurement period. So all these things are special points we need to discuss. We need to give some more time also. I think that point we will take it up tomorrow. So one more question is coming. Irrespective of percentage of acquisition, the same treatment, sir, unlike in consolidation, subsidiary associates. No, I have not got the question. Sorry, Ajay Chandra, I have not got the question. Irrespective of percentage of acquisition, same treatment, unlike in consolidation or subsidiary associate. I have not got the question. Because for you to become holding subsidiary, first Ind AS 103 is applied. Then only other things are applied. Okay. So before we close today, any questions pertaining to today class that I need to explain? Ind AS 103 basics we understood. Advanced things, other points we will discuss that point tomorrow, and we will be solving problems, reverse merger. We will be solving full-fledged question, previous exam question, and I'll be solving one common control question solves. Okay, I think you all of you got the point. So just like yesterday, today also I'll be releasing 20 MCQ questions. Please make sure that you fill all the details required. This will only be for new syllabus. This today's MCQ will not be for old syllabus, only for new syllabus. Questions will be there. You can address, and results I will update. I will send it to you by mail. Make sure your email ID is correct once all these revision classes are over. I hope these revision classes are giving you some form of benefits. If you find it beneficial, please pass on the message to others so that instead of watching it later, they can watch it live and ask their doubts and get your doubts clarified. Just one more question for the confirmation. Who has the control is accounting owner, right? Perfect. Accounting owner is the one who got the control. If I get the control, I am the accounting acquirer. Correct. Okay, so be prepared for one more level of torturing tomorrow, because tomorrow you will need to go for reverse merger cases. Reverse merger have not come in the exam yet. So very simple, but might be tricky. It is connected with Ind AS 33. EPS also will be connecting it. So tomorrow is also a very important day. So what are the key takeaways from today? Please revise the today session. Solve more number of problems. Any doubts, please ask in the Telegram channel. I will be posting the today's charts, important charts in the group. You can use it. Even the consolidation balance sheet also I will share it there for your reference. Second, please share it among your friends so that they also get the benefit. Please share this format of consolidation. Let everybody get the benefit. Third point, please take the MCQ assessment test, because more number of people you get, I will be able to know the pain points and you get the better results. Okay, I hope you're enjoying all these classes. Happy learning, happy earning, and all positive things. Don't worry about any negative things happening outside. Stay home, stay focused, and happy learning. Thank you so much for the opportunity. Tomorrow we'll see you at same time, 11 o'clock. See you all.